All right, everyone, let's get started with tonight's presentation, a San Diego real estate and economic update. Tonight, we're going to include a lot of new information, including statistical data on what has happened in the real estate market in just the last month or two. We'll also take a look at what's bound to happen in the real estate market in the coming future through the rest of 2023 and into 2024. So with that, let me quickly start out with an introduction on myself. My name is Patrick Kappel. I am the team leader of the Kappel Realty Group based here in San Diego. We belong to a large brokerage that has a network of agents throughout the United States. That brokerage is Compass, the #1 brokerage in the United States for 2 or 3 years in a row now. You can see my experience there on the left. I've been in the San Diego real estate industry for a little over 15 years now. I started out while I was serving on active duty in the Navy. I've got a full 23 years now in the Navy, but when I started out, I was just a young guy in my 20s, and in between every military deployment, I would buy a new property. After enough military deployments, I accumulated 8 properties that my wife and I now own, and I transitioned from the full-time military to becoming a reservist in the Navy and working in brokerage full-time, running the team that I have today. I'm also a board member of the Southern California Apartment Association. And the team that I've assembled and that I run today with about 12 agents on it has sold nearly $500 million in just the last 5 years of San Diego real estate. That's composed of over 750 units. With that, as you can see on the far right, we've become one of the top teams, not just in San Diego, not just in California, but in the United States. We're ranked in the top 1% of all real estate brokerage teams in the United States. Additionally, we're ranked number 31 in the entire state of California amongst large real estate teams, those teams with 10 to 20 people on them. A few other awards that you see there on the right, and a lot of it comes down to what you see in the center, and that is education. My mom and dad are both, they're retired now, but they were both high school teachers. They really instilled the value of education upon myself and my siblings. So you see quite a bit there in the center. I started out, starting at the bottom, with a bachelor's degree from the U.S. Naval Academy, where I earned my commission and my undergrad degree. I followed that up with an MBA at the UCLA Anderson School of Management. And I followed that up with a Master's of Science degree in real estate at the University of San Diego. So as you can tell, I'm not just your typical real estate agent that's out there to sell a house, but I also enjoy educating, specifically educating the clients that work with my team and educating everyone within our team. So I can guarantee you when you work with the Kappel Realty Group, you're working with an educated team. That said, if you go out there to buy, sell real estate, at the end of the day, work with who you want to work with, but I just ask you work with someone that takes this profession seriously, because there's a lot of part-timers within our industry. One last thing I want to highlight before we get in the nuts and bolts of today's presentation is that recent recognition we got, because it just came out last week. And as you can see by the write-up in front of you, this really ranking is done by a company called Real Trends, which looks at agents and teams throughout the United States when it comes to ranking who's the best of the best. And for the 3rd year in a row now, we've been ranked in the top 1%. It's the highest we've been ranked in the state of California at 31, with a little over 112 million sold last year in 2022. So again, who you work with does certainly matter. And at the end of tonight's presentation, you are going to know more about real estate and the current status of the real estate market than most real estate agents do. And if you do want to go out there and take action by buying or selling real estate, feel free to reach out to myself or my team. We'll be happy to assist you. I'll end with the slide you see in front of it, but I also like to start with it in case you want to jot down my email or contact info. Anyone that emails and asks for a copy of tonight's presentation, I will send it to you. Additionally, we have a YouTube channel that has tonight's presentation being uploaded on it later on this evening, and a lot of other real estate presentations I think you'll find extremely valuable. To find our YouTube channel, it's pretty simple. Just go to YouTube, type in my last name, Kappel Realty Group, and you'll see lots of videos that pertain to the real estate market, buying investment real estate, how to save on taxes with real estate, and update on what's going on, not just in San Diego, but nationally. With that, let's get into the meat and potatoes of tonight's presentation. I always like to start out with this saying, and that is that San Diego today is San Francisco circa 1990. And what I mean by that is the real estate values in San Francisco in 1990 were relatively affordable, kind of in line with the national and California prices. Then in the 1990s, something really big happened, not just in San Francisco, but throughout the world. And it happened to have a base in San Francisco, and that is the silicon chip boom. The powers to be decided that San Francisco and the Bay Area was going to become Silicon Valley. And when all of a sudden a bunch of venture capital money and businesses about this next wave of innovation, the silicon chip, decided to set up shop in San Francisco, we saw the influx of money and businesses cause a rapid increase and longevity in the appreciation of real estate values in San Francisco. We're seeing the same thing in San Diego, but we're at the very forefront beginnings of that happening in San Diego. What do I mean by all of that? Well, I like to explain things with math, charts, and data. So here's your first chart. This chart is a little bit of a history lesson and a little bit of a real estate lessons to help you make your decisions today. Because if there's one good teacher, it's history. So we can see here, if we go back to the early 1990s, real estate values for single family homes and condos in the San Francisco Bay Area weren't that much greater than what we saw throughout the rest of the state of California and the nation. California you see in red, the nation you see in blue. But as you see throughout the late 90s and into the 2000s to current day, we saw real estate values escalate extremely fast in the Bay Area. And it wasn't because all of a sudden they built bigger, better, cooler houses. They were the same homes, just appreciating more and faster than the rest of the state, rest of the nation, because of the economic changes that happened in San Francisco in the 1990s and early 2000s due to the silicon boom. So back to that thesis statement of tonight's presentation, San Diego today is San Francisco 1990. Why do I say that? Because there is a new technological boom that is happening right now, affecting real estate values in a few key cities, and that is the biotech boom. And the biotech boom, just as the silicon chip boom started in San Francisco in the 90s, the biotech boom is focused on 3 cities: Boston on the East Coast, San Francisco, and San Diego on the West Coast. The big difference, however, between San Diego and San Francisco, as you can see in the chart in front of you, is the value of real estate. Real estate is much cheaper in San Diego compared to San Francisco. So we have been, and we will continue to see San Diego real estate values outpace, in the form of appreciation, the values of homes across the nation, the state, and San Francisco. I've got a chart later in the presentation, about an hour in the presentation tonight. You will see the relative appreciation rates of different cities, including San Diego, and I think you'll be happily surprised. So with that, what are we going to cover tonight? We'll start out this evening with the latest data. We're going to talk about the latest monthly data that we have. Now, we're still in the month of June, so the latest monthly data we have is from the month of May, which we just recently closed out. We'll take a look at what homes are selling for. Are they selling for below or above list price, median and average list price? What's the inventory? We'll talk about that probably for the first 20 to 30 minutes tonight. Then we're going to take a step back and look at the broader economy and discuss how and why the broader economy is affecting the real estate market. Because as a consumer out there that might be thinking, you might want to buy a house this year, you might want to sell a house, you're wondering if you should wait, we're going to tie in the economics of reality, how they affect housing, to help you make an informed decision. Again, you might be thinking, well, how's a real estate agent going to give us this? As you remember from the previous slide, I've got 2 master's degrees, one in business with a focus in finance, studied a lot of economics, and the other with a Master of Science in Real Estate itself, backed by, again, finance and economics. So once we start talking about the broad economy, it's important that we dive a little deeper into San Diego's economy. So when I talk about things about homes that have been built, jobs that are growing, we'll talk nationally and also specifically San Diego. And of course, we'll talk San Diego housing and show you what's going on and what's not going on with the San Diego housing environment. Last but not least, I'll give you a glimpse into the crystal ball, if you will, and give you a look ahead at projections that many economists and experts are making for the coming year into 2024. I always like to cite my sources. Some of them I've cited on slides, but some of the general areas where I got a lot of this information, because I'm always asked, where do you get all this data, Patrick? One of them is Keeping Current Matters. The other is UCLA Anderson, which gives a quarterly forecast. San Diego Association of Governments, San Diego Association of Realtors, along with the California Association of Realtors. And there's lots of other sources I'll do my best to cite throughout the presentation. But trust me when I say I have probably collected from 20 to 30 different sources, spent countless hours to put together one concise 90-minute presentation that we'll cover tonight. One place I don't get my sources is headlines. Headlines terrify, data clarifies. Guys, news is made to sell. It doesn't matter what network you listen to, Fox or CNN, newspapers or magazines. Their number one goal, by understanding, is to stay in business. They got to make money, so they'll do what sells. And headlines, terrible news can always sell, but data clarifies. However, as you know, and a lot of people tell me, data can be very boring, even though I find it exciting. We are going to dive into data tonight, and I hope I make it a little bit interesting. I certainly will not make it terrifying, because if you understand data, there is no reason to be scared. But as this says, the screen says in front of you, there's a lot of misconceptions out there. There's a lot of folks that don't understand economics, finance, or housing that are providing misleading advice. So I ask you, whatever you've heard out there, read in the news, heard from your friend, whatever your mom and dad has told you, whatever your cousin, uncle, aunt, or whoever has told you, let's just put that in a box and lock it up for 90 minutes. And let's look at real data, so that you can make your own informed decision, not based on what your friend or coworker told you, but based on real data. Tonight, we will not look at opinions, we will look at data. So get ready for one of the most data-intense real estate presentations of your life. We'll start out by saying, guys, we don't have an interest rate problem. Everyone's talking about interest rates. I get it. They're pretty high. They're around 7% right now. But what we really have is an inventory problem, because at the end of the day, interest rates can be manipulated overnight. We can go from 6 to 6.5 to 7, 7.5, and crank it back down. These are all easy levers that the Federal Reserve and Wall Street can push, pull up and down. But what you can't change quickly is the amount of housing inventory. So no matter what happens to interest rates, they can go up or down. We are not solving the housing inventory problem. You'll see some data and some charts that back that up. But at the end of the day, Economics 101 tells us that the value of everything in life comes down to supply and demand. That's it. Of course, there's things that can affect supply. There's things that affect demand. But if you can crunch it all down to what is our supply and what is our demand, I can tell you the price of anything and what direction it's going to go, just based on those two things, supply and demand. And we simply do not have enough supply. With a lack of supply relative to demand, prices go up. It's pretty much basic high school economics. So let's take a look at the latest raw numbers of what's going on with real estate, and we'll kind of start to tie it in and backfill it as we look at economics. Starting out with what's going on in San Diego County, the last month of data, month of May, average sales price. I'm not going to spend a lot of time on average because I really like median. The reason is average, for those of you familiar with the difference, you already know. But for those of you who are not, average simply takes the sales price of every single family home in the blue line and divides it by the number of sales price, number of homes. So if you had 100 homes sell at all kinds of varying prices, you add up all the prices divided by 100. The next chart we're going to look at is the median price, which looks at the one in the middle. the one in which half the homes sold for less, half of them sold for more. We like median because average can be a little bit skewed sometimes by a property that sold for a lot of money. Imagine like if Oprah came here and bought a $1 billion house, that would really skew things high. But nonetheless, it's worth looking at average to see some trends. And we can see that the market, the real estate market, was really going up ever since COVID. We hit a peak around April of 2022. And then in May, we started to see interest rates go up. May of 2022, June, July, August of 2022, interest rates kept going up. That squashed demand a little bit, and we saw prices go down. Now, prices pretty much hit a bottom around December, January, as they always do every year. And since December and January, we are starting to see prices come back up. And in fact, they're getting pretty close. Some of them are almost already at the high price point we hit before. Now, if you ask me, we're going to keep on going higher because we see prices going up to new peaks, even at 7% interest rates. Imagine what is going to happen when interest rates start to go back down. Now, the chart I really want you to lean into is this one, median sales price. Again, the difference between average and median is average takes the sales price of everything added up divided by a number that sold. The median is simply taking the house or the condo in which half the property sold for more, half of them sold for less. It's the one right in the middle. Think of that with median. As I mentioned earlier, single family homes in blue and condos in red. We hit the bottom in December, January. And the bottom that we hit and the pricing that was caused was a little bit artificially pushed down by these high interest rates when they went from 3 to 4 and 4 to 5, 5 to 6, and 6 to 7. As you can see in the detached column here, we hit that low on real estate values, about $849,000 median sales price for a single family home in January. As of last month, May, we're up to $955,000. Folks, that is a 12.5% increase in value in just 4 months, January to February, March, April, May. To see 12% increase in 4 months when we are at 6 to 7% interest rates on the 30-year mortgage, that tells you one thing. That tells you we don't have enough inventory. A, we have not built enough inventory in the last decade. And B, just as importantly, these high interest rates are keeping sellers from wanting to sell. Imagine if you're a homeowner, and some of you probably are. Imagine if you're a homeowner and you've got an interest rate right now, 3% or 4%. 75%, over 75% of homeowners have an interest rate in the 2s or the 3s. The majority, even more homeowners, have an interest rate in the 4s, below 5s. So with these homeowners having such low interest rates, they just don't want to bring their inventory to market. And even in a high interest rate environment of today, 7%, we're seeing prices go up. Now in the news, you will hear them say home prices are down 2.6%. Home prices are down 5%. Why would the media be telling you home prices are down when they're actually up 12% year to date? It's because most journalists and most in the media are quoting and looking at year over year data. And when we look at June of 2022, we see the median sales price of $975. And we look at May of 2023, we see a median sales price of $955,000. Well, it's easy to see that from June of last year to May of this year, we are down about 2% or so. But looking at year over year data is a waste of your time because it doesn't show you what direction anything is going. It certainly doesn't show you the direction of the housing, which you really should look at to know what direction the housing market is going is month over month data. That's why this year over year change, the negative numbers that you see a lot, maybe in the media, just ignore those and instead look at the raw numbers of what is really happening to real estate values. And we see that they're actually going up exponentially fast. Trust me when I say this, when interest rates go back down to the sixes, to the fives, to the fours, you are going to see home prices skyrocket. For this reason, my team is telling our clients the wise thing to do is buy now while real estate values are relatively affordable and cheap, and refinance later. Now, I know what you're thinking. You're thinking, man, Patrick, 955,000, that's not cheap. And I would say, well, it depends. It's not cheap compared to what real estate values were 5 years ago, 10 years ago, but it's exceptionally cheap compared to what real estate values will be in 5 years from now, 10 years from now into the future. You see, in economics and in finance, you will never make good decisions if all you do is look backwards. You need to have the ability to look forwards to see what direction the value of things are going, stocks, bonds, or real estate in this case. Hopefully, again, by the end of tonight's presentation, you'll have a bit more of an idea on how to judge that direction. So we see that sales prices are going up. Why are values going up, even with 7% interest rates? We've already explained it, but here it is in raw data. We just don't have enough homes for sale. In fact, on this chart, which goes back 10 years on the bottom, you can see that we typically have around 2,000 to 3,000 new homes coming for sale every single month. In fact, during the months of May, we usually have closer to 3,000 homes coming for sale. And right now, we last month had about 1,500 single family homes come for sale on the market. That's over 40% less than what we saw last year, and certainly less than what we typically see. The next chart here shows you pending sales. How many homes are going into escrow? Everyone thought, oh my gosh, there's going to be a crash. And people were saying that last fall. They were saying that earlier in the year. And they weren't realizing that every fall, every winter, sales go down, prices go down a bit, and they always pick up in the spring. And we saw just that happen here. As you see here on the bottom right-hand side of the chart, the pickup in sales in blue and red, that's your single family and your condos. What the next one I really like to look at is closed sales. Just because something's a pending sale doesn't mean it's closed. It means an offer was accepted and now the buyer's doing their inspection, but they might back out. As we see here, though, year-to-date closed sales are down, but it's due to low inventory. And when I say year-to-date on this chart, you might be thinking, well, Patrick, what do you mean? In January and February, we only sold 900 and 1,000 homes, respectively, and now we're 1,370. What I'm referring to is year-to-date compared to last year. And you see that here kind of in the center, a little bit on the left where I'm circling. Year-to-date, so between January and in May of 2023, San Diego County, we've sold 5,867 single-family homes. Last year, it was 8,746, and the year before, 2021, was 9,784. What does this mean? Does this mean people don't want to buy homes? Not at all. What it means is we just don't have the inventory to sell. We're selling about 13, almost 1,400 homes per month. And as you saw here, we had in April, we had 1,400 homes come to market, 1,428. Usually the homes that come to market in a given month, i.e. April, you see 1,428 came to market, they usually sell the following month in May. We sold 1,370. So pretty much every home that goes for sale is being sold within 30 days. You'll see that chart as we go on in the presentation. Now, original list price. What percent of original list price are homes selling at? We had peaked out last summer in June at 101.6% of list price, and we're back at it again. As you can see in the month of May 2023, the median single family home sold at 101.1% of list price. Condo sold at 101.3%. So what does that mean to you if you're a buyer? Most properties, not all, but most are selling above list price. Now, when homes start selling above 100% of list price, that is simply another indicator that demand is outweighing supply. And again, what happens to anything, including real estate, When demand outweighs supply, the prices go up. As I see the increasing trend of sales to list price go from 95 to 97% to 98%, 99%, now 101%, that trend is telling me prices are likely to keep on going up. So again, this is why I say if you're a buyer, buy today. Don't wait. The longer you wait, the more you will pay. Bottom line. Days on market. This is another indicator that, from an economics perspective, tells us prices will keep going up. Remember, in the world of finance and real estate, and just about everything, in fact, if you can see the history, great. But you need to be able to interpretate that to look into the future. They say nobody can predict the future. I say that's a lie. Anyone who understands how to read historical data, more importantly, historical data trends, can read and predict the future. It's not that hard. And as we see here, we hit a maximum days on market. What does days on market mean? Days on market means from the moment someone pounds a for sale sign into the front yard to an offer being accepted, opening escrow. That's days on market. Remember how I said that prices bottomed out in December, January? Well, look at the trend line here that I'm circling with my cursor. You can see from June of last year to today, the days on market, the length of time it took to sell a house, peaked going into December, January, February, when we hit the bottom. As days on market goes up, prices start to slow down on their increases and sometimes even drop. Since January and February, though, days on market has been dropping, and it's stabilized a little bit in May. We held out at 29 days on market for single family homes. For attached homes, which would be condos and townhomes, we dropped to 23, telling us that condos are selling exceptionally fast. Well, when you see this trend of days on market going down, it's telling you prices are going to keep going up. Now, inventory of homes. I already showed you how many homes are coming to market every month. This is the amount of homes currently sitting on the market that are available right now for sale. And we're sitting around 2,000 homes for sale. That might sound like a lot, but it's a fraction, guys. Usually in San Diego County, pre-pandemic, pre-COVID, we would have around 8,000 to 10,000 homes for sale. 8,000 to 10,000 homes for sale during the month of June. As you can see on the bottom chart, that dropped like a cliff going into COVID. A lot of people held on to their homes. They refinanced into super low interest rates. And with that low interest rate, they have what we call the golden handcuffs. They don't want to lose their 3 or 4% interest rate by selling. So they're just staying put. That ensures we have very low inventory of homes. And buyers right now are outweighing sellers. Whenever we have inventory below 4,000 to 3,000 homes, you can rest assured we will see prices go up. And again, that is why even with 7% interest rates, we're going to keep seeing those home prices go up. Another thing worth noting here is about a third of homes today that are selling are being bought by all cash buyers. And you might wonder, well, where are all these people getting cash? Where are people getting $1 million cash? Well, a lot of folks moving into San Diego are moving here from places like Seattle, San Francisco, Los Angeles. And a lot of these people have owned a home in these markets for 10, 15, 20 years. They're selling the home, taking their cash proceeds, coming down here to San Diego and buying all cash. Again, we're going to keep seeing our values go up because of these trends occurring, just like San Francisco did in the 90s. We're seeing it happen in San Diego. Months of supply of inventory. This is simply how many months of inventory do we have on the market? By definition, that means if no new homes come to market, how long would it take for every home on the market to be sold off? The 2,000 homes that we have on the market today, we know that we're selling about 1,500 100 homes a month, it would take about 1.6 months and all 2,000 homes would be sold. Anytime we have less than 4 to 6 months of inventory, that's a pretty hot market, not enough inventory. Supply is not equal to demand, with demand outweighing it, and you're going to see prices go up. Guys, there are a few markets in the United States of America that have such low inventory relative to demand, relative to San Diego. That's why San Diego is going to be one of the fastest appreciating markets that you see now and into the future. I included this chart for those of you out there who are shopping and looking to buy a house. This simply shows you the demand versus the inventory broken down by price point. So let's use this, the first price point as an example. If you are, let's say, a first-time home buyer and you're looking to buy a condo and you're looking to buy something at $750,000 or less, you are looking at 26% of the current inventory on the market. However, that is also comprising 40% of demand. So what does this mean to you? 40% of home buyers want to buy a house 750,000 or below, and that makes up only 26% of inventory. So as a buyer at the lower price points, that's where you're often going to see homes sell for more than list price. You have to be really aggressive on your offers. You have to work with a really smart real estate agent to make sure they know how to write your offer, structure the contingencies, and include the verbiage in the offer to get your offer accepted. I couldn't tell you enough times, the worst thing you can do as a buyer is work with an inexperienced agent that hasn't gotten a few deals under their belt. Don't hire someone just because they're your friend or your relative. Now let's look at another example. If you are shopping in the 1 million to 1.25 million price point, that's 9% of the inventory, 10% of the demand. Pretty balanced, pretty balanced. Now, if you're looking 2 million and above, you can see that 16% of inventory, over 6% of demand, only 6% of demand. So those homes sit just a little bit longer before they sell. So with all that on the latest data in San Diego, if you have any questions about that stuff, type them into the chat. And at the end of tonight's presentation, I'll answer 100% of the questions that come up. But let's move off of the last month's data and let's get into the economics and the big data that is affecting housing and prices beyond just the interest rates we've already talked about. When you look at homes and the values of them, you can't just look on Zillow. You can't just read a headline. You got to look at a lot of information, a lot of data, compile it, tie it together, and see what picture gets painted. I like to say real estate and the trajectory it goes is a lot like building a puzzle. If you have one piece of a puzzle, you have no idea what the picture looks like. If you have 2 to 5 pieces of puzzle, you have no idea what the picture looks like, but you get a general idea. Once you get all the pieces of the puzzle and you start putting them together, you build a beautiful puzzle and you see exactly what is going on. So let's start putting together some other pieces of this real estate puzzle to see what's going on today, what has been going on the last 5 to 10 years, and what's likely to happen in the next 5 to 10 years. The first piece of this puzzle I'd like to share with you is demographics. Who buys houses? Human beings. They need to live in houses. So if you want to look at the demand side of the supply-demand equation, we got to look at humans and just how many there are. Now, there's a few things we need to take into consideration. The first being that your typical first-time home buyer is about 33 years old. Some people buy homes sooner, some buy them later, but if you average it out, 33. So we see a lot of people start to get married, have babies, want to buy a house, happens in their early 30s. Now, when the Great Recession occurred, around the time I graduated college, in 2006, we had a deficit of first-time buyers. We didn't have that many people that wanted to buy houses because that was Generation X, my generation, and it just wasn't that big compared to baby boomers, and it certainly wasn't that big compared to millennials. Today, the demand side of the equation is hitting some all-time highs because of millennials. Millennials are now in their early 30s. they're hitting their first time home buyer age. They want to buy homes. And right behind millennials are those Gen Z folks like my daughter. More Gen Z people want to buy homes than millennials. And look how big the Gen Z cohort is. Now, when you look at the demand side of the equation, these huge populations coming down the pipeline, millennials and Gen Zs, that means nothing by itself until you take it into context of the supply side of the equation. So let's take a look at supply. This is our existing home inventory for sale. Now let's go back to like 2006, 7, and 8. Again, around the time I graduated college. We had some of the highest amounts of supplies we'd ever seen, around 4 million homes for sale in the United States of America. Now, balanced market in the US, we really should have about 1.8 to 2 million homes for sale. As we fast forward to 2023, we see that because we have not built enough homes in the last decade, and now combined with sellers not wanting to sell because they have low interest rates, we are sitting at all-time historical lows of inventory of homes for sale. So I like to call this a perfect storm. I don't know how many of you have seen the George Clooney movie called The Perfect Storm. It's a great movie if you haven't seen it. But the perfect storm in real estate is these two charts on top of each other. We, as you see in the top, have the lowest amount of inventory ever, certainly in my lifetime, intersecting with the crossroads of the largest demographic generation in my lifetime hitting first-time homebuyer age. When you have your largest demographic reaching their early 30s, intersecting the same year that the United States has the least amount of homes for sale, what is going to happen to the value? This is like having a bar with 100 thirsty people wanting to buy a beer coming into the bar, and the bar only has on stock 8 bottles of beer. How much are those bottles of beer going to sell for? What are they going to be valued at? They can sell it to the highest bidder. They'll sell it to the 8 richest people out of those 100. So I'm telling you right now, if you are waiting for prices to go down, do not hold your breath. You will not make it. You need to buy sooner than later before prices go up even more and you get priced out of the market. Now, trust me, prices will keep going up. And we see that shortage of housing blown up here on this chart for specifically San Diego County. In the county of San Diego, we are short by almost 80,000 housing units relative to what our population growth has been. You can see the demand growth, 15,000 units a year. This means based on just San Diego County's growing population, we need 15,000 new housing units every single year. But we simply have not built enough in the last decade. So what is the bottom line? There's a lot of data, and we're going to get into some more data. But what's the bottom line here? The bottom line is a few things. One, there is not a real estate crash on the horizon. Anyone who tells you there is doesn't understand economics or real estate. I don't know a single respected economist that is saying there's a real estate crash. They're all saying prices are going to keep going up. Number two, there's not enough real estate supply, period. Number three, over the long term, real estate prices will keep going up. Probably in the next 10 years, they'll go up more than they had in the last 10 years. Number four, if you are a renter, trust me when I say this, especially in San Diego, rent will keep going up, probably more than you want it to. And five, finally, now is a good time to buy real estate, even with the high interest rates, because you can always refinance out of it. As I mentioned earlier, and you see here now, just a different colored chart that goes back to 2020, we have already increased 12%, 12.5% to be exact, just this year when it comes to single family detached homes. Starting in January, we're at 849. And last May, we closed out the month with the median sales price being $955,000. And again, anyone who's telling you there's going to be a crash or a correction in the market, Tell them to look backwards in time to December, January, and tell them that's where the bottom happened. In fact, you can see it clear as day on the blue chart here where that little dip occurred, and we have come out of it. Now, attached homes such as condos experienced their bottom at 585 back in December, and in last May we saw home prices at 640,000 for attached condos. It's about a 9.4% increase over a period of 5 months. So what is going to happen? Well, guys, we are seeing prices go up with 7% interest rates. What do you think is going to happen when interest rates go down even more? What do you think is going to happen when interest rates go down to 6%, to 5.5%, to 5%? I can tell you, as you see in the chart in front of us, buyer demand gets stronger and stronger as interest rates go down. And as buyer demand starts to gain strength with lower interest rates, you will see home values go back up. Even if some more sellers bring their homes to the market, we simply don't have enough homes built to satisfy the need of buyer demands. So are interest rates going to go down? How come they're going up? Because you all saw them go up to around 7% last week or two. Well, I've got an answer for that. And I'm going to explain interest rates to you and why they are what they are. Before I explain why they are what they are, let's take a look at some of the projections that three of the leading economic organizations are looking at from now to the rest of the year and going into 2024. Let's just kind of look at the averages of all three. And we see that by the end of this year, most of these economic organizations that work in the real estate industry are projecting rates to be in the low sixes or the high fives. As we get into 2024, they're really starting to see them stabilize lower into the mid fives. If interest rates are at 7% now, why would interest rates go down? Especially if the Federal Reserve increases interest rates another 0.25%. We'll answer that question, and I want to really highlight how that will affect things when it comes to pricing and when it comes to affordability. Let's say you've got a buyer who wants a $4,000 a month mortgage, and rates are 7% as they are today. Well, a buyer who wants a $4,000 mortgage and a 7% interest rate as they are today is going to buy something for maybe around $750,000. That's assuming they put down about 20%. And of course, you can put down much less. You can put down as low as 0%. In fact, we have a lot of clients do that. But now let's say over the next year or two, interest rates drop from 7 to 5 to 4.5. If interest rates are at 4.5, that same $4,000 can now buy $1 million property. Now, I don't think interest rates are going to go up that much more beyond 7%, but they certainly are going to go down. And as you can see, as interest rates go down, the buying power of buyers goes up. As you've already been shown, there's more buyers than there is supply. So we will see prices of real estate go up as interest rates go down. But will interest rates go down? Well, let's do a quick little 4-minute education on why real estate interest rates are what they are. You see, mortgage interest rates typically have about a 1 to 1.5% spread above the rate on the 10-year Treasury note. Now, United States government treasuries, also known as U.S. bonds, government bonds, treasury bonds, are known to be one of the safest investments in the world. So whenever Wall Street in the financial markets value any other investment, they compare it to 10-year Treasury notes. And they say, well, this investment's a little bit riskier than Treasury notes, so we need a little bit of a risk premium. So they tack on 1 to 1.5%. Now, mortgages, when you go out and get a mortgage, your mortgage is bundled with thousands of other mortgages. And then it's sold on Wall Street. And Wall Street will buy these mortgages, but they will expect the mortgages to pay them about 1 to 1.5% more than what a 10-year treasury would be. So as you can imagine, whatever the 10-year treasury is and whatever interest rate that's at today, mortgages should be about 1.5% higher than that. So we see that correlation here going back 20 plus years. And we can see that from January 2000 to current day, there's a pretty even spread between the 10-year treasury in blue and the 30-year mortgage in red. And that spread is usually about 1.5%. A lot of economists in real estate say that the 10-year treasury and the 30-year mortgage have a dance that they do together, and they always keep 1.5% separation between the two. However, recently, the spread between the 10-year treasury and the 30-year mortgage has increased, as you can see in this chart. Why has that gap increased? In fact, it started around November 2021, and it kept on increasing to November 2022. It increased to about 3%. So right now, 10-year treasuries are trading at about 3.5 to 4%. I think last I looked, it was around 3.7. So 30-year mortgage rates should be about 5.2, but we're seeing them closer to around 7. Why is that? It's because around late 2021, early 2022, people started saying the R word, recession. When anyone starts saying the recession word, lenders start to be more uneasy about wanting to lend money to you and me and every other consumer. When lenders become uneasy to want to lend, they start raising the spread that they, the investor, the lender, needs to get on the 30-year mortgage. So they artificially increase the 30-year mortgage, which today should be at about 5 to 5.5%, artificially increased it to 7%. Because lenders are thinking there might be a recession, they don't want to give out as many loans. So to not give as many loans, let's just jack up interest rates. And the number two reason is when we hit recessions, interest rates go down. If you're a lender, would you want to lend money today to a homeowner hoping it's a 30-year mortgage, but knowing that during the next recession, which could be just around the corner, that homeowner is going to refinance the mortgage to a lower interest rate, and there goes your 30-year mortgage that investor just invested in. That's the other reason they got interest rates so high, up around 7%, so that they can try and make their money back, or at least a portion of it, before you refinance it in a year or two. What you're looking at right now is that 10-year US Treasury. Let's see, where are we at? 3.7%. I was right. The latest 10-year US Treasury is right here at 3.7%, as you can see on the far right, indicating that interest rates today on 30-year mortgages should be closer to 5.2 to 5.5. This is why most economists are predicting interest rates to come down, even if the Federal Reserve increases rates a little bit, because the Federal Reserve rate is not tied to the 30-year mortgage. And this is why I can confidently say I expect rates to be in the high fives at the worst within the next 12 months. So knowing all of this information, what should you do? Should you wait to buy? Should you wait for interest rates to come down before you buy? Or should you buy and then wait? The answer is very clear, especially based on the data that we have all already looked at. You should buy now while prices are still low and competition is relatively low, because we know, based on historical data and real data, when interest rates do go back down, buyers are going to flood back into the market. You're not going to, though, all of a sudden see a flood of inventory. So when interest rates go back down, buyers flood in the market, you will see home values go back up. So smart buyers today are buying at today's prices. And then when interest rates go down in 6 months, in 12 months, you can refinance that interest rate and you can refinance your mortgage. So you might get a 7% interest rate today, buying a $900,000 home. But when rates go back down to the 5s or 6, you can refinance that mortgage to a lower interest rate. And you're going to see all your friends and your peers who haven't bought yet buying homes 6 to 12 months from now when interest rates go down. And for that 900,000 home that you bought, they're going to buy the equivalent home for 1.1 million, 1.2 million. Because when you see rates go down in the fives, that's how much we could see homes appreciate up to. Additionally, right now, there are a lot of down payment assistance programs. One of them is called the 2-1 buy down program, where you can buy down your interest rate, or even better yet, you can have the seller buy down your interest rate so that you can buy now with lower interest rates that'll stay with you for at least 2 years. We've helped a lot of our clients get the seller to buy down their interest rates. Right now, there are also available to you a lot of down payment assistance programs in which the state of California will pay for a large chunk of your down payment when you're buying a house. And a lot of these programs are grants, money you never have to pay back. So if there's ever a time that you wanted to buy a house and not use your own money, but use the government's money, now is the time. Now, I know this looks like an eye chart. Don't let it scare you. We're going to zoom in. I built this when I was in, actually, I built this right after graduate school. And I built it to show a lot of the clients I work with the math, the difference between renting versus owning. Now, there's a lot of calculations, a lot of math in this, but I'm going to zoom in on the important stuff and really break this down. This really applies to those of you who are renters thinking about owning, but it also applies to you if you're already a real estate owner, you own your house perhaps, and you're thinking about investing in real estate. Let's take a look at this mathematical example. What you have in front of you on the left-hand side is an address, 801 West Hawthorne Street, number 210. I know this property very well because I've owned it myself since 2009. The asking price, if I sold it today, $500,000 all day long. So let's say as a consumer, you're renting a property. And let's say you can rent this exact same condo for $3,000 a month. Or you could buy it, but your mortgage is going to be $3,990. Now, if I told your typical American that you can live in this condo and you can either rent it and pay $3,000 or you can own it and pay $3,990, most Americans would say, well, heck, I'm going to rent it because $3,000 is cheaper than $3,990. A lot of magazines and news articles will tell you that it's cheaper to rent it than it is to own because $3,000 is less than $39.90. And to these people, I say they haven't really peeled back the layers of the math to fully understand the true cost of renting versus owning. Now, if you only have 12 months left to live, then I would say go ahead and rent. Because it's, I mean, to own it, it's assuming you're going to live another 5, 10, 15 years. But I'm assuming most of you have long lives ahead of you, and I hope you do. So let's peel back the layers of this mathematical onion. Let's say you buy it for $500,000, 100% purchase price, circled over here. Let's say your down payment is only 5%, $25,000 gets you this house, this condo, and you finance the other $475,000 with a 6.5% interest rate, which you can get these days. Well, there's a few assumptions we need to make. One, on the far right, you see your taxes, 1.25% of purchase price. That is a typical tax rate for San Diego County real estate. And per a California law, your real estate taxes can never go up more than 2% a year. So we've got that 2% baked into the equation. Your insurance on a property like this will probably be about $800 a month. And your HOAs are probably going to be, $800 a year. And your HOA fees are going to be about $400 a month, plus or minus. We're also going to assume, to be honest with ourselves, these go up 3% every year, rate of inflation or so. A couple of last assumptions you see in the bottom left. Annual rate of appreciation, 6%. Why am I using that? Because the annual rate of appreciation in San Diego over the last 35 years, that's a long time, has been 6%. Pretty good, solid data to go off of. And we'll use that, even though if you ask me, I bet you appreciation is going to be even greater due to the biotech boom and the housing shortage that we had. But we'll go with 6%. I also know you can rent this for $3,000 because I'm renting it to a tenant right now. And the annual rate of rental increase is about 5%. It can be as high as 10% though. But per California law, every landlord can raise tenants' rent at least 5% up to 10% every single year. So now let's take our eyes back over to the right. As the owner of this property, on the far right, as I already said, you're paying on year one, you pay $3,990 a month. As a renter, you pay $3,000. But we know that when you buy a property, your mortgage is fixed and your mortgage does not go up year over year the way rent does. Rent does go up year over year. And if it goes up 5%, you'd be surprised how big of a number that can be over the decades. So over 30 years, the owner pays $1.597 million. The renter pays $2.391 million. That is a difference of almost $800,000. So you can easily see the renter pays far more than the owner does over a lifetime of renting versus owning. You can also see that at year 31, and this assumes like you drop dead at year 30, but you know what? You're probably going to keep on living into your 60s, your 70s, your 80s, maybe your 90s, making ownership even cheaper. Because at year 31, your mortgage is paid off. All that you have left is your real estate taxes, your insurance, and your HOA, which at the point of year 31 is now going to be just over $2,000 a month. However, for the renter, I feel sorry for the renter because at year 31, not only do you still have your rent, but if your $3,000 a month rent has gone up just 5%, not 10, just 5% year over year, by year 31, your rent is now over $12,000 a month, not a year, a month. And that seems like a lot of money to pay in rent because it is a lot of money to pay in rent, but that is the power of compound interest. Now we see in the last column I haven't mentioned yet, the increase in your net worth. If you own the property and you have a $500,000 property that appreciates at 6% a year, within 30 years, that property will be worth over $3 million. And you will not be a millionaire, you will be a multi-millionaire because your mortgage is all paid off. Whereas the renter has a net worth of zero still because they've built no equity in those assets. So as you can see here, it is extremely expensive to rent. And you can become a multi-millionaire by owning. And trust me, guys, I have seen this, I have lived this. This is how real estate works. This is how finance works. This is how the world works. Unfortunately, most people don't understand this because they don't teach it in schools. In my opinion, they should teach this in high school so that as soon as someone graduates high school or college, one of their number one goals is to go out and buy a home so they can start building their own equity and financial security over time. Anyway, I love that chart because it really breaks it out. Macroeconomics. Let's talk a little bit more about how they are affecting real estate. Inflation. Inflation has been like the buzzword for the last year or two, but inflation is really starting to calm down. We just got May inflation month over month, 0.1%, super low. In fact, when you keep hearing these high inflation numbers, guys, of like 5-6%, and that's because it's year over year data. Again, you got to look at month over month to see what direction we're going. And in the next couple of months, you're going to start hearing some much lower inflation numbers, especially when we get into August and September. Why is that? Because May 2022 and June 2022 are going to fall off the radar as we move and we start looking at year over year data. And those were exceptionally high inflation months last year. Every month since then has been 0.5% or lower. Inflation is being tamed. With this said, another indicator that will help drive down interest rates. As we talk about inflation, though, it's important to talk about how inflation affects home values. In fact, home ownership is one of the best hedges you can have against inflation. As you see in the chart in front of you, we're looking at every single decade going back 50 years. And decade over decade, we see what is the average inflation rate of that decade and what was the average home price appreciation of that decade. year over year. And as you can see, the green is typically higher than the blue, which in layman's terms is telling you homes outpace inflation. So if you want to hedge against inflation, you want to own real estate. On the contrary, if you are a renter, you are getting a double whammy to the face, because not only are you missing out on not enjoying the appreciating benefits of home ownership, appreciating more than inflation, but you're getting punched a second time in the face because rent often goes up faster than inflation. This is really cruel. In fact, it's a cruel world. I wouldn't deny it. It's even more cruel to those who rent versus those who own, which again is why I say preach to your children. Buy real estate as soon as they get out of school, as soon as they can afford it, to save all your money. Skip that fancy meal out, go buy real estate. Because if you're renting, you can see here the green line is often higher than the blue line. What is this telling us? Again, going back 50 years, that rental real estate appreciation is outpacing inflation. Your rents are going up faster than inflation. Now, this came out last October, and there were a lot of people saying the recession word, recession. We may or may not have a recession, guys. 9 months ago, they were saying 100% probability. We shall see if we have that recession or if we don't have the recession. Either way, it's good news for real estate. Recessions aren't bad for real estate, and let's take a look at why. As we look back again almost half a century, we see that of the last 6 recessions, during 4 of them, home prices actually went up. In fact, the only recession which home prices really went down was the Great Recession, 2008, which was caused by poor lending standards, caused by the housing market. We're not in that situation today. And you might be wondering, why do home prices go up during recessions? Well, there's an easy answer to that, and here it is. A recession means falling mortgage rates. In fact, 100% of the time, and guys, 100% is pretty good data to go off of. 100% of the time we've had recessions the last half century, we see mortgage interest rates go down. And as I already educated you on about a half hour ago, when we see mortgage rates go down, we see real estate values go up because we see buyers' purchasing power go up. And you might be thinking, well, during a recession, doesn't everyone lose their job? No. In fact, during recessions, most college educated people do not lose their job. When you look at recessionary data, although we might see unemployment levels as high as 10 to 15%, those with college educations, the unemployments only go to like 2 or 3%. Why is that important to know? Well, it really dictates a lot of things, including where I invest. I know that in San Diego, most people can't afford a home unless they have a college education. And I want to invest in areas where those who own homes are not those who get laid off in recessions, because then you can see a housing crash. If you invest in a city or a state where just about anyone can own a home, then the chances of having more foreclosures and whatnot during a recession are a little bit higher, but still not that high, because we see those mortgage rates coming down. Guys, this is also one of the reasons why lenders really don't want to give loans right now, and why they artificially jacked up interest rates to 7%, even though they should be around 5.5%. Because if lenders are expecting a recession and expecting interest rates to go down, why would they want to give you a 30-year fixed mortgage knowing you're going to refinance it in a year or two? It's just painting all these pictures that rates will go down. Another indication of why you can't believe the hype out there, it was about a year ago that I saw some Facebook posts and some Instagram posts and some grifters on YouTube saying that there's a big crash on the horizon because US foreclosure activity doubled. In fact, this was a headline I pulled off of a news story. US foreclosure activity doubles annually. But what you got to look at is the fine print. And although from 2021 to 2022, foreclosure levels did double from 151,000 to 324,000, foreclosures were still historically low and well below the pre-pandemic foreclosure levels, guys. Foreclosures are almost non-existent, especially when we zoom in on San Diego County. What you're looking at right now is the number of homes in San Diego County in foreclosure, and it's pretty darn close to zero. It certainly isn't like it was in 2012, 13, and 14. It's just a very strong market. So what is the forecast for the rest of this year and going into next year? Well, as we look again at a lot of economic forecasts and reports, we see that the majority are forecasting appreciation in 2023. Now, the infographic that I have in front of you right now came out in December. So it's a little bit dated, let's be honest. And that's why I added to the right what San Diego has already done. You see, these forecasters were actually being a little bit conservative, and they were giving national home price forecasts. And you and I already know that San Diego on average appreciates more and faster than the rest of the nation because of a lot of reasons, including the biotech boom. But you can see here that when you average out the national forecast, they're all expecting about 1.8% on average appreciation this year. San Diego has already blown far past that with about 12.5% appreciation year to date. Now, when you break down 100 different economists across the nation, and you ask them, do you think United States real estate is going to appreciate or depreciate this year? And if so, by how much? We can see again, the majority of United States economists at the beginning of the year were projecting housing appreciation, with most of them expecting about 3 to 5% appreciation. When you prolong that out and you look at next year, and 2025 and 2026, and you ask these same economists, in 2024, will homes appreciate or depreciate? Same in 25, same in 2026. You see that a growing percentage of economists year over year into the future are projecting home appreciation. Why is that? Because these economists are looking at the same things you and I have spent this hour looking at. They're looking at the demographics of millennials and Gen Zs wanting to buy homes. They're looking at the reality of inventory being at all-time historical lows. And when they put on their supply and demand thinking hats, they realize, well, of course it's going to keep appreciating because that's what economics tells us. So let's take a look at California and San Diego economy. When it comes down to it, guys, I've probably said this phrase more than any: supply, demand, supply, demand, supply, demand. Because, guys, the value of everything on earth comes down to supply and demand. You send me something that doesn't come down to supply and demand, shoot me an email. I'd be interested to hear about it. And sometimes things are artificially suppressed, like oil. You just saw that Saudi Arabia wanted to cap a few wells. So when it comes to supply and demand, you've already seen this chart. But in San Diego, locally here, we need to build over 15,000 units a year. We just haven't built enough, leaving us with an 80,000 unit shortage. I also like to remind everyone that the value of real estate is heavily based upon the value of the economy around that real estate. That's why a home in San Diego could be $1 million and a home in South Dakota is 200,000, because the San Diego economy is much bigger than the South Dakota economy. I think the mayor of San Diego is probably in charge of a bigger economy than some governors are in a state. So let's talk a little bit about San Diego and California's economy, especially taking into consideration that the value of real estate, along with supply and demand, is heavily weighted by the value of the economy around it. Well, California is poised to overtake Germany as the world's 4th largest economy. If California was a nation, we would be the 4th largest nation on the globe in terms of economic size. And you can see here in blue the growth of California's economy over the last 20 years compared to the growth of Germany's economy. Now, I've got some really great photos of the United States here showing you the sizes and growth of different economies around the nation. Now, this is great to look at, not just if you're buying real estate in California, but if you're buying real estate anywhere in the United States. This is the type of data to know, especially if you're investing. So, what is the gross domestic product of these states? GDP. GDP is really just the size of the economy. And you can see that by far, California has the largest economy in the entire United States at $3.36 trillion in 2021, compared to second place, Texas, Yes, I know I probably just offended a bunch of people from Texas. I'm sorry. I've been to the state. I love Austin. But you got second place here when it comes to GDP because California is number one as an economic powerhouse. Almost, not quite, but almost two times greater than the second place economy. I don't like to look at just nominal GDP though. I like to really drill into it and take a look at what is GDP per capita. So what does that mean? How big is the economy? How much money is coming into the economy per person in that state? Because let's be honest with ourselves, it's people that buy real estate. So as a real estate buyer, it's nice to know where our value is going to go up, and they're probably going to go up where you have more GDP per person. No surprise. We see the East Coast and the West Coast, especially Washington, where you got Seattle, California, where you got LA, San Francisco, and San Diego. You've got New York, Connecticut out here on the East. You got North Dakota. That's my home state. And why is that? Probably because of the oil output. But I can tell you, as a guy from North Dakota, that oil money is going into the hands of very few, not most of the state. But as a real estate buyer, you want to know, where do we have high GDP per capita? Because those real estate values will likely hold. Where would I not buy real estate? I would not buy real estate in any of these states that are really light colored because they just don't have a lot of money per person. You're never going to see your real estate values go up that much. You're going to see maybe more foreclosures, tenants not paying rent, that type of thing. This is another great one. And this ties in quickly. And again, oh man, I hate to beat up on Texas because I like Austin, but Texas isn't even top five when it comes to GDP. I guess I draw this analogy because people say everyone's moving to Texas. Uh, there's some caveats to that which we can get into. But a lot of people are moving to California, specifically those who have money, those who can afford the beautiful weather, the beautiful environment that we have out here, and all the job growth that we have here. And you see that here in this growth chart. Where is money moving to? Where is money growing? And California again makes it within the top five. Those states on here that are the darker green are those states that have the greatest economic growth currently going. And those are the states, again, real estate is highly correlated to the value of the economy around it. These darker green states, you're going to see more of the economic growth. This last chart on GDP shows as a percentage of the entire United States GDP, each state's makeup. And again, you see California here making up almost 15% of the entire nation's gross domestic product. Now, when you zoom in from California, biggest GDP in the nation, let's take a look at San Diego, which has one of the biggest GDPs in all of California. San Diego is a powerhouse, not just as a city, but as an economy. You can see in the bottom left that our geographical region, our county, is made up of a younger, richer, and better educated demographic. All of these things, guys, play into the values of housing. As a homeowner or as a real estate investor, one question on your mind is my real estate purchase going to go up in value, or is it going to go down? And as we can see here, when you surround your real estate with people that have good jobs, good educations, a growing workforce, the value of your real estate is likely to go up. We also have some pretty significant driving sectors, including tourism, innovation, and the military. In fact, another thing beyond these driving sectors worth noting is no more than 16% of the economy is made up of any one industry, indicating that we have a very recession resilient economy. But the biggest part and the best part of that economy, guys, is the life sciences, the biotech, these different 6 waves of innovation, which have changed humankind forever, changed cities forever, the way the 5th wave, the microchip and CPU, changed Silicon Valley forever. Back to our thesis statement, life sciences are changing San Diego forever and changing San Diego real estate forever. And how is that happening? Boom, right here. The chart in front of you explains it all. Let the money do the talking, as I like to say. And San Diego investment, money flowing into here. On average, for the last 10 to 20 years, San Diego County has received an average of about $1.1 billion per year in venture capital investment money. Now, that sounds like a big number because it is, But look how much the numbers grew from 2019 to 2021. We saw, compared to the 10-year average, an 8.6x increase in venture capital investment in San Diego County to $9 billion in 2021. You simply cannot have that much of an influx of cash into any region and not have it affect the values of real estate. When we break down that venture capital money, we see that over half of it is going to life sciences, but a not insignificant amount is going to just general tech companies, as you see on the far left. And not just early stage tech companies in biotech, but also sustaining growth company guys. So with all of this money coming in, let's paint that picture back to San Francisco 1990s. If you bought some San Francisco real estate in the 1990s, you would be a multimillionaire today, many times over. And I'm telling you, the same thing's going to happen here in San Diego. If you buy real estate in San Diego today, fast forward 10, 20, 30 years, you will be a multimillionaire because of what's happening economically and demographically. When you break San Diego's venture capital investment money down and compare it to the other cities in the United States, and guys, before I close out this presentation, you are gonna see that San Diego is one of the best cities in the world, not just a nation, in the world to buy real estate, especially if you want to become a multimillionaire. Maybe you don't want to, that's fine. But if you want to at least just have a financial asset, a home that doesn't go down in value, but goes up, San Diego is one of the best. What you're looking at right now is some of the top cities in the United States. What is not included in here is your Boston and your San Francisco, your cities that were already large economic powerhouses in the tech field. And we're looking at those cities that just in the last 10 years or so have started to become new freshmen in the tech field. And amongst all of these new freshman cities growing in tech, we see that San Diego has outpaced all of them when it comes to biotech and venture capital investment coming into these cities' metro areas. It's reflected in a lot of stories that came out in the last year, including this one, that San Diego biotech real estate soars with sales topping 3.4 billion in just the last 12 months. There's so many other stories that compare San Diego today to San Francisco circa 1990, like the IQHQ San Diego Research and Development District. This is a 1.6 billion oceanfront biotech development happening right now downtown San Diego. You see the buildings going up if you've been downtown. And this is going to be the largest Class A biotech space on the Pacific Coast waterfront on the west coast of the United States. Huge development. And just one block away, we have a $3.5 billion development, the Seaport Village redevelopment, that is going to occur over the next 10 years through multiple phases. Moving a little bit east into Mission Valley. Now, I was just at Snapdragon Stadium the other day, but beyond the stadium, we have the Innovation District being built where we're going to have a lot of SDSU classrooms, student housing, retail centers, and this is coming in at a price tag of just over $1 billion as well to start up a lot of incubators amongst these college students. We have a $4 billion project happening in Mission Valley's Riverwalk. This is going to be apartment buildings, retail shops, office buildings. When it's all said and done, there's going to be over 4,000 new apartments and over 150 new square feet of retail stores and 1 million square feet of office space. The big news last year was Apple coming into San Diego. Apple is bringing 5,000 new jobs right here into the city of San Diego, and they have identified our region as the one that will become the principal engineering hub for Apple by the year 2026. And they put their money where their mouth was. Just in this last year, they spent nearly $500 million to buy a brand new Apple campus right here in San Diego. In fact, one of my latest clients works for Apple. We're starting to see a lot of Apple people moving into our region. And speaking to biotech, well, you can't talk about that without healthcare. There's a brand new $2.5 billion hospital being built by UCSD in the Hillcrest area. And a few blocks away, also in Hillcrest, Scripps Mercy has unveiled a brand new $1 billion hospital that's being created. I'm telling you folks, there's just billions upon billions of dollars coming into the San Diego region, including the $2.8 billion also being built right on the bay in South County along the waterfront of Chula Vista, where they're building one of the largest conference centers in San Diego County and five-star hotels. And just to the east of that, in Otay Mesa and Eastlake, we have the largest Amazon facility ever built in the state of California, right here in San Diego. So if you don't think San Diego is the next San Francisco, take another look at all the development and all the tech that is moving into here. And you can't move all those people into here without growing our transportation hub. So another large multi-billion-dollar project is the San Diego International Airport Terminal 1 project at $2.7 billion. This is going to transform our airport to have many more jet bridges and stations for airplanes to come in, as well as room for travelers coming in and out of San Diego. Our military economy, I mentioned already, is one of our driving forces. And one little known fact is every year, 15,000 military veterans get out of the military in San Diego, and over half of them stay here and are added to our substantial tech force that keeps on growing in our region. And a little known fact as well is that San Diego is the #2 recipient of United States Department of Defense dollars. Many of you likely already know that 50% roughly of the United States government's budget is spent on defense. That's a pretty big amount. And the #2 recipient of those defense dollars is right here in good old San Diego. San Diego has also shown exceptional snapback in growth since the pandemic. We see when ranked against every major city in the United States, no city has recovered more from the pandemic than downtown San Diego. In fact, downtown San Diego recovered by 99% within 2 years. Our revenue, our tax revenue, as you see in the bottom right, is higher now than it was pre-pandemic. And just in the last year, 2022, we added 297 new businesses in our downtown region. And it's not just the folks in San Diego that love it, but people around the nation want to live in San Diego. Again, we just don't have enough housing, but those folks who can afford it are flocking in. In fact, San Diego is ranked as the 3rd highest metropolitan city in the United States for net inflow of people moving here. So anyone who's telling you that everyone's leaving San Diego, stop listening to them. There are people leaving San Diego, but there are far more people moving into San Diego. And let's be honest with ourselves. The people leaving San Diego are not homeowners. They're not the ones who are buying homes. They're the ones who can't afford it anymore, getting pushed out by the high rent. They're moving to Texas. The folks moving into San Diego are the folks that can afford it, the folks that have 6-figure jobs. And oh, by the way, guess which state Texas sends the most amount of Texans to? California. A lot of people are moving here from Texas, specifically those that can afford it and work in the tech field. This here just shows you the rankings. In fact, #2 city that folks are moving to is Sacramento, another California city. But #3, here we are, San Diego, with a lot of people moving here from LA and Seattle, Washington. A lot of reason people can move here as well is because of remote work. We saw remote work grow tremendously in 2021 going into 2022. And if you make enough money and you can work anywhere in the world, why would you not live in San Diego when you're working, especially if you're coming from like the Midwest or the cold East Coast, both places I've lived. So we've already said San Diego is ranked #3 in the nation on net migration, people moving in. But I always like to say it doesn't matter just how many people move in, it matters who is moving in, especially if you want to see how is that going to affect real estate values. And we see that the majority of folks moving to San Diego is comprised of tech talent. This is research that was produced by LinkedIn, and nobody knows better than LinkedIn who is moving where, because LinkedIn knows your college level, they know your job, they might even know your income, they know your network, they know what type of career field you're in, so they can track where are tech people moving to. And as you see in front of you, from 2019 to 2022, no city in America had greater growth in their tech talent than San Diego. Again, this goes back to the thesis statement. San Diego today, San Francisco circa 1990. When we look at where are people moving, and importantly, where are they moving away from? Wherever you see orange, those are counties that people are moving away from. These are counties I would not recommend investing in. Certainly don't buy real estate in these counties because the value of your property is probably going to go down because the demand, the number of people there is going to go down. Where should you buy real estate? The counties you see in green. The county you see in green are counties that have growing populations percentage wise. And as we look here at this next map, we see which counties are growing based on the raw numbers. The darker the green, the more people moving there, the more growth. And as you can see, it doesn't get any darker green than San Diego County. What does this tell you? We, again, just tying that story, we have a max influx of people moving here, and it's a highly talented people moving into our region. This United States map in front of you shows you just how many people are moving into our region. And if you focus in on San Diego County, you see from the latest census between 2010 in 2020, that San Diego County grew by 229,000 people, quite a bit of growth. So is San Diego cheap? Guys, I'm telling you, if you want to know something's expensive or cheap, don't look at what it was. Don't look at the price of something today compared to the price it was yesterday. Look at the price of something today versus the price it will be tomorrow, because you can never go back to yesterday, but you will always move forward to tomorrow. And if you want to make wise investment decisions, you buy things that will go up in value tomorrow. And I'm telling you, San Diego has some of the most undervalued real estate in the world. And we see that the price appreciation is happening now and only growing. What you're looking at in front of you is appreciation levels of California's 3 largest cities. San Francisco has always been number 1. San Francisco has always been the leader of the pack on appreciation. All of that changed around 2021 when San Diego took first place and will continue to do so from here on out as we keep on growing. Because again, San Francisco of 1990s is San Diego today. And the explosion boom that San Francisco saw in real estate values over the last 10, 20, 30 years, you will see in San Diego over the next 10, 20, 30 years. The shortage of housing is further exemplified nationally by the chart you see in front of you. We usually build about 11 to 12 million homes per decade in the United States. And in the last decade, 2010 to 2019, we only built about 6.5 million. If you zoom in on San Diego County, you see that 70,000 unit shortage. It's really just a deficit of homes we did not build. The chart I really love though is this one because it really breaks it down by the numbers. We need to now build over 21,000 homes per year just to meet housing demand. We are building on average since 2015 only 9,027 homes. Back in 2021, we built them only 7,600. We are building, folks, less than 50% of the homes we need in our county. So you tell me what's going to happen to home prices when supply is so low relative to demand. And that lack of supply has intersected with the biotech boom. Draw your eyes to the bottom right. And we know that biotech boom, based on the chart and data we already looked at, really began in 2018, 19, and 20. That is when our household growth really started growing, the orange line. And that household growth was all the 6-figure, some of them 7-figure earning biotech folks moving into San Diego. And at the same time, we started building less and less housing units. This is why you're seeing home prices go up so drastically in San Diego. And it's not just me saying we have a shortage. It's all the experts, all the economists. We do not have enough units. It's going to take far more than a decade to build enough to satisfy our demand. When we look at San Diego and we look at demographics, we are a millennial city. In fact, you can see the average percentage of millennials in the US is 21.7, but in San Diego, over a quarter of our population is millennials, and these people all need to buy housing. But when you zoom in beyond millennials and you look at these Gen Zers, which are in their 20s now, and they're right on their heels, almost 50% of Gen Zers want to buy a home in the next 5 years. When you ask, do you want to buy a home in the next 10 years? You have another 28%, a total of over 70% of Gen Zers plan on buying within the next 10 years. And when you compare the Gen Zers to the millennials, the dark purple versus the light, you see that 87% want to own a home someday compared to 63% of millennials. You see that 68% of Gen Z see home ownership as a way to build their financial security compared to 60% of millennials. So what is this telling us? This huge demographic wave of Gen Z right behind millennials is even more so going to want to buy housing, and we have not built the housing for them. So you are even more so going to see real estate values increase over the next 10 years. There is no bubble. It is a lack of supply, folks. Prices will escalate. You will see the median sales price in San Diego. Right now it's 955,000. By the end of this year, I bet you we'll be up around $1 million. Within the next 10 years, our median sales price will be 1.5 to 1.75 million. Mark my word on that. And we know we don't have a bubble because lending standards are tight and they're still under control. You're looking at your mortgage availability index, which simply shows how hard or easy it is to get a loan. The lower the index, the harder it is to get a loan. And we have been very strict about which home buyers can get access to financing just to ensure we don't have a crash. I'm not going to go through each line item here. You can watch the recording and pause it on the slide if you would like, but you can see the differences between this housing cycle and the last housing cycle and why this housing cycle doesn't have one single indicator that there's a crash on the horizon. There just simply is not. If anything, we have massive appreciation on the horizon in front of us. So what are the experts saying about home prices? As you see here from Financial Advisor's recent article, waiting for home prices to drop is simply a bad strategy. It's not going to happen. And even Barbara Corcoran, who you all know from the Shark Tank series, she's one of the women sitting there on Shark Tank, but she is not initially known for being a shark on Shark Tank or a business owner. She's initially known for working in real estate and working in real estate brokerage. And as you see from her quote in front of you, Barbara is saying it is a great time to buy real estate because of what I told you earlier. When interest rates go down, everybody waiting on the sidelines is going to rush into the market. In her words right here, prices are going to explode and you're going to be paying more for the same house. You can always refinance when interest rates come down. So what is Barbara saying? She's saying buy now before rates go down and prices go up, prices explode. This woman has been in real estate for probably as long as I've been alive. She knows what she's talking about. Another reason to own, and I think we covered this in the Excel spreadsheet, the average household net worth throughout the United States is significantly higher for real estate owners in orange compared to renters that you see in gray. Ironically, the real net worth of renters has gone down since 2001. And we see the real net worth of owners around 250,000. Renters are really being punished because rents keep on going up. And as we zoom in on specific cities, we see which metropolitan cities have had the most rent growth. And on the far right, you see over the past 3 years, what cities have had the most rent growth, and San Diego falls into the top 10 with 29% rent growth in just 3 years. Now that spreadsheet I showed you earlier, I was kind of nice to the tenant and we just increased our rent 5% year over year. But look at this, San Diego rents realistically are actually going up nearly 10% per year, year over year. So what do? I know a lot of Gen Zs. I know a lot of every generation doesn't know how to get started in buying a home. In fact, quite often the biggest obstacle is not having enough money for the down payment. We see here that 21.9% of respondents said the biggest obstacle to buying a house is not having enough down payment. The number two obstacle is not knowing where to begin. And the number three obstacle is finding the house in the price range. Again, this is why it's important you work with a real estate agent that is a professional and knows what they're doing. I can tell you right now, although not all real estate agents know about these programs, most don't. In fact, there are a lot of free down payment assistance programs. What do I mean when I say that? Government programs that give you money to go buy a house. I know it sounds too good to be true, but trust me, I am, as a guy in the Navy who still I have a top secret clearance still, I would not lie. We have helped our own clients buy real estate with zero money down. One of my own team members just bought a house and he got $150,000 approximately from the state of California to buy that house. We had another team member of ours. She helped her sister buy a house with no money down, got a grant from California. So if the down payment is holding you back, send me an email, contact me. We can help find that free money down payment assistance from the government for you. Number two, knowing where to begin. Where you begin is usually a one-on-one meeting with a reputable real estate agent. A lot of times a consumer will send me an email, say, hey, Patrick, I want to buy a house. Can you help us get started? And we do an initial 60-minute meeting. So those obstacles, guys, they're really easy to overcome. The challenge is, understandably, most consumers don't know about these programs. They don't know where to begin because they don't work in the industry. And I get it, which is why it's so important you work with someone who is a professional in that industry. So I'll close it out by saying we have a California gold rush going on, but not in the mountains of Julian. It's happening right here in the streets of California, where real people just like you are buying houses, buying condos, buying starter homes, buying duplexes and investments, and they're growing these properties into hundreds of thousands and millions of dollars in net worth. I have seen many of our clients literally become millionaires just by owning real estate. And always remember, if you want to get to that space, that position that you want to be in, you want to cross that finish line, whatever that finish line might be. But in this instance, maybe it's owning a house, owning an investment property. Well, in order to cross the finish line, you must first cross the starting line. And as I mentioned earlier, what does that starting line look like? It often looks like a one-on-one meeting with me and one of my team members. So if you are interested in buying real estate, selling real estate, or you just want to learn more about these down payment assistance programs, how do you get started? Can you afford anything in San Diego? Guys, I met one time with a guy who he was living on the streets and without a job. My team and I will meet with anyone and everyone to help get you started. And it doesn't matter if you're ready to buy right now or if you're not ready to buy for years. If you just want more information on how to prepare and get ready to buy your next property or your first property, reach out to me, reach out to my team, and we'll schedule an initial 60-minute introductory Zoom call. Zoom is super easy. You can do it from your house. You're doing it right now, probably watching this video. And from the comfort of your home, we'll talk real estate, learn more about you and how we can help set you up on the path of success that you want in real estate. With that, I'll close it out by sharing my email one last time. If you'd like a recorded copy of tonight's presentation, or if you'd like to schedule that one-on-one Zoom meeting to learn more about real estate and how we can help you, feel free to reach out to me. I love meeting with people. I love learning about different people's backgrounds, their stories, and their goals with real estate. Most importantly, my team and I love helping people get into their first home, their first investment property, and beyond. So please reach out to me at patrick.kappel@compass.com, and we'll be more than happy to meet with you and help you on your real estate journey. With that, If you have any questions, please type them into the chat. Right now, it looks like there are not any questions. I guess I did a pretty good job answering just about anything. But if you have any questions, feel free to reach out to me at any time in the future, and we'll be here to help you. Thank you for joining us this evening. Have a good night.